high-stakes poker, international terrorism, and creepy guys who bleed tears.
Nothing sinister.
I'm Peter Billigus, and this is Money in the Movies. Hello and welcome to Money in the Movies, a show where we review films based on their financial accuracy. Today's film is Casino Royale, directed by Martin Campbell and starring Daniel Craig as the legendary James Bond.
Your name, sir?
James Bond.
Now, years ago, I reviewed this film for Money in the Movies, but I am going back over some of the films I reviewed in our new and hopefully improved format to take a closer look. In the case of Casino Royale, there was something big that I missed. The movie opens with a scene in Uganda. Okay, fine. The movie actually opens in Prague, but after the credits, we go to Uganda. Here we are. The film's antagonist, Lashif, is a banker to the world's terrorists. He is having a meeting in the middle of the jungle with a freedom fighter who is looking to invest some of his cash.
I want no risk in the portfolio.
Okay, let me stop it right there. There is no such thing as a risk-free portfolio. Despite what anyone tells you, there is no such thing as a risk-free portfolio. There are certain investments that are referred to as risk-free, such as treasury bills or maybe an FDIC-insured bank savings account, but what that really means is that these accounts are free from market risk. There are many other types of risk in addition to market risk. There is inflation risk, legislative risk, bankruptcy risk, interest rate risk, fraud risk, FTX, tax risk, and insurance risk. In the case of real estate investments, there are also mechanical risks, which would involve something like a heating system breaking down. I have a property with a heating system from 1987. Come on, 10 more years. So all investments are subject to some form of risk. Just remember that. When someone tells you this investment is risk-free, what they typically mean is that it is safe from market risk, not all risk. But let's assume our freedom-fighting friend understands that the portfolio is not risk-free, because no portfolio is. He is simply stating his desire to not have any market risk. Let's see what Lashif does with this dude's money.
I have the money, so short another million shares of Skyfleet stock.
Sir, you must know you're betting against the market. No one expects this stock to go anywhere but up.
Okay, so let's look at what's going on there with the movie and whether or not that would actually happen. Lashif is the client, and this dude is obviously the stockbroker. Lashif is trying to conduct a transaction through his broker, who has a license to help other people buy and sell stocks and charge a commission to do that. Now, the first thing we need to know is that just because Lashif just got a bunch of cash in the middle of a Ugandan jungle, well, that doesn't mean he can start using that money to trade stocks. Brokerage companies do not accept cash. They'll take a check or a bank wire, but not cash. So first, Lashif would need to get this cash into a bank. But if he showed up with this much cash at a bank, that bank, whatever country it is in, is going to start asking questions. Certain countries, like the United States, will make you fill out forms disclosing where you got this money. Those forms will then be sent to the IRS, and amounts of this size, people are going to take a closer look. Now, it is theoretically possible that Lashif would have a network of bankers on the take who would help him launder this money, but it would take a lot of time to get it from the Ugandan jungle to his brokerage firm in Great Britain. So that part is totally inaccurate. It would never happen that fast, if it could even happen at all. It does, however, appear that Lashif has a brokerage account with this dude's brokerage firm, and it looks like a legitimate account. I mean, the guy has a British accent and he has leather-bound books in his office. What more do you want from your brokerage firm? This gives us a chance to talk about brokerage accounts. The two most common types of brokerage accounts are cash accounts and margin accounts. A cash account is a brokerage account that only allows you to trade investments with limited losses using only the money you have in your account. There is a fancy financial term for buying limited loss investments, and that term is long. When you are long on an investment, you own it, and you can only lose what you own. People will say right now, I'm long on Microsoft or I'm long on Nike, and that just means that the worst thing that can happen is your investment goes to zero and you lose everything. But it's everything that you own. So with a cash account at a brokerage firm, you can only go long on investments, and you can only buy those investments with the money that is already in your account. Cash accounts are the simpler of the two types of brokerage accounts, and they're also the easier accounts to get. If you have enough money to meet the minimum requirements to open the account, maybe as low as $1,000, well then you can get a cash account at a brokerage company. A margin account is an account that allows you to do two things a cash account will not. Number one, you can borrow money from your broker to make trades, and number two, you can trade investments with unlimited losses. More on that in a minute. With a margin account, you are able to borrow money from your brokerage company to make trades. Typically, the broker will ask for the stock you are buying to act as collateral. So you might say to your broker, I want to borrow $10,000 to buy $10,000 of Walmart stock. Your broker would put $10,000 into your account as a loan, and you can buy Walmart with that borrowed money. Now remember, this is a loan, so you will need to make interest payments to your broker. But as long as you make those payments, things should be good. Unless Walmart stock plummets. When the collateral you used is worth less than what the broker loaned you, the broker might ask for a margin call. That's when the broker says, hey, the collateral you gave us isn't worth as much as it was. We need you to put a little bit more money into your account. Margin account rules are set by the Federal Reserve's Regulation T, not to be confused with Mr. T.
What you doing, sucker?
But each brokerage firm can add additional limitations to their margin call policies. So one thing you can do with a margin account that you cannot do with a cash account is trade with borrowed money. The second thing that you can do with a margin account is you can trade short. Trading short also means you can get into trades with unlimited losses. Now, why would you ever want to trade an investment with the potential of unlimited loss? Well, trading short allows you to make money when the price of an investment goes down. Confused? Me too. Remember, when you are long on an investment, that means you own it. Because you own it, you are hoping the price will go up. But there are ways to make money when the stock market goes down, and one of those ways is to short sell a stock. Most investment strategies involve buying an investment at a low price and then selling it at a higher price. Short selling, or shorting, works in reverse. You sell high and then buy low. When you short a stock, you borrow that stock from another investor. You sell their stock at a high price and wait for the stock to go down. If and when it does, you buy that stock back at the lower price and then return the stock to the person you borrowed it from. So people who short a stock are hoping it will go down. In the film, Lashif gives the stock market a little help. Once he has the freedom fighter's cash, he calls his stockbroker and says,
I have the money, so short another million shares of Skyfleet stock.
No one expects this stock to go anywhere but up.
So our tears of blood crying friend...
Nothing sinister.
Yeah, tell that to your prom date's father. Anyway, once our tears of blood crying friend has the cash, he calls his broker to short the stock. The broker is like, dude, this stock is gonna go up. And Lashif is like, dude, this stock is gonna go down. And I'm gonna make sure it goes down because I got a guy, I got a keychain, and I got a fuel truck that keeps leaking gas. And keeps leaking gas. And keeps leaking gas. And, well, you get the idea. Thankfully, James Bond stops the terrorist. The stock does go up, and because of his risky investment move, Lashif loses
$101,206,000.
But here's something interesting. Something I missed the first time I reviewed this film. At the beginning of the film, Lashif says, short another 1 million shares of Skyfleet stock. So Lashif told his broker to do a short sale. But after James Bond saves the day, the broker tells Lashif something interesting. He says,
The put's expired. I'm sorry, I'm not sure yet how much you've lost.
the put's expired? What does that mean? Well, short selling is one way to make money when the stock market goes down. Another way is to buy something known as a put option. Options are a type of derivative investment. A derivative investment is simply an investment whose value is based on another underlying investment. With options, you don't own the underlying investment, you own the right to do something with the underlying investment. Options are the rights to buy or sell a certain stock for a certain price within a certain time. And there are two basic types of options. There are put options and there are call options. When you buy a put option, you want the stock price to go down. When you buy a call option, you want the stock price to go up. The simplest way to remember this is you put your foot down and you call your friend up. When you buy a put option, you are buying the right to sell the stock at a certain price. Suppose I think XYZ stock is going to go down. I would buy a $5 put option on 100 shares of XYZ stock, which is currently trading at $100 per share. That means that over the next few months, I have the right to sell the stock for $100 per share. But right now the stock is trading at $100 per share, so anyone can sell it for that much money. My option isn't worth anything. But now imagine the price of XYZ stock drops to $20 per share. Everyone who owns the stock can sell it for $20 per share, but I have the right to sell it for $100 per share. Now, if the stock is trading for $20 per share, and I have the right to sell it for $100 per share, well, who would buy it for me? Why buy something for $100 that is currently trading for $20? Well, the answer is, when I bought the put option, someone else sold me the option. They thought the stock would go up. I thought it would go down. I had to pay them for the right to sell the stock, and they received that money. If the stock's price stayed where it was, or if it went up, I am out of the money I paid for the option, and they got a little extra income. But if the stock goes down, they are obligated to buy the stock from me at $100 per share. Remember, I bought the right to sell at $100, and they sold me that right, which means they are responsible for buying back that stock at $100 per share for as long as I own the option. Most option contracts are typically for less than a year, and it's important to know that in analyzing the film. So getting back to the film.
I have the money, so short another million shares of Skyfleet stock.
The put's expired. I'm sorry, I'm not sure yet how much you've lost.
So it appears the film made a blunder, one that I didn't notice the first time around. Lashif tells his broker to short sell the stock, but after James Bond saves the day, the broker says the put's expired. Those are two different investment strategies. Now, both short selling and buying put options are a way to make money when the market goes down, but there are key differences. With short selling, there is unlimited risk. If you are short a stock and the price keeps going up, there's no ceiling on how much you can lose. But with put options, you can only lose the price of the option. So limited risk is one advantage of put options. But remember, put options have a time limit. So you may be right, but if you're too early, you will lose everything. With short selling, there is no limit on time. You can short a stock for years if you want to. The point here is that the film appears to make a mistake, confusing the two investment strategies. Lashif tells his broker to short the stock, but when everything goes wrong, the broker tells Lashif the put's expired. Again, that was something I missed the first time I reviewed this film. There is another important financial lesson in the film that does have some hard-to-handle, real-life truth.
When they analysed the stock market after 9/11, when the stocks hit bottom on 9/12, somebody made a fortune.
A tactic similar to Lashif's plan appears to have been used to profit from the terrorist attacks of 9/11. Before the attacks, the U.S. government found a large number of put options were purchased on American Airlines stock. After the attacks, American Airlines stock did go down, making the investors of those put options a lot of money very quickly. Investors short the market or buy put options when they believe bad news is on the way and the market is going to go down. But both of these strategies have their risk, and short selling is one of the few investment strategies that carries unlimited risk. While put options don't have unlimited risk, there is a time risk that if you aren't right in the right amount of time, you will lose everything you invested. For most of us, you, me, and Mr. I Cry Tears of Blood,
Nothing sinister.
we should pass on short selling and put options. That being said, the film is accurate in its portrayal of how short selling works and how put options work. You make money on both when the price goes down. But the film does appear to confuse short selling with put options. These are two different investment strategies, so I'm going to amend my review I gave so many years ago, so I give it 3 out of $3 signs. And for our new updated version, I'm going to give it 2 out of $3 signs. If you enjoyed this episode, please hit the like button and consider subscribing to the channel. And if you have an idea of a movie that I should review for its financial accuracy, please let me know in the comments section below. Until then, thanks for watching. I'm Peter Billigus, and this is Money in the Movies.